there is $2.9 trillion of additional economy generation out of the AI deployment.
The impact of artificial intelligence, AI, on the world economy is profound and multifaceted, reshaping industries, labor markets, and global competitiveness. As AI technologies continue to advance, their influence extends beyond traditional sectors, touching every aspect of economic activity. The integration of AI into various domains such as finance, healthcare, manufacturing, and services has generated both opportunities and challenges, ultimately redefining the dynamics of the global economy. Welcome to Live Economic News. In today's video, we explore the ways AI is reshaping industries, influencing productivity, and ushering in a new era of economic evolution. Don't forget to give it a thumbs up and subscribe to our channel. Based on a recent survey, nearly 80% of our clients conveyed the belief that artificial intelligence, AI, will exert a transformative influence on the global economy. However, the survey also uncovered uncertainties regarding the nature of this transformation. Client opinions diverged on whether the AI revolution would be predominantly confined to the United States. Additionally, while more than half of respondents perceived the emergence of an AI bubble in financial markets, a third remained uncertain. Recognizing the absence of a comprehensive framework for contemplating AI's consequences in the global debate, our Spotlight report aims to fill this void. The report provides insights into how AI will reshape the global economy from various perspectives, elucidating the anticipated substantial productivity boost in certain major economies. Introducing our proprietary AI Economic Impact Index, Capital Economics empowers clients with a clear understanding of AI's repercussions on the global economic order, highlighting countries positioned to exploit AI's economic benefits and those facing challenges. An extreme illustration occurred during the Industrial Revolution in the UK, specifically in a 50-year period known as Engels' Pause, characterized by robust innovation and capital accumulation, but low productivity growth. In the second phase, the technology undergoes refinement. The cost of implementation generally decreases, and its adoption becomes more widespread, ultimately leading to significant productivity gains. Finally, the third phase witnesses the onset of the law of diminishing marginal returns. At this juncture, the pace of improvements and implementations decelerates, causing a tapering off of productivity gains. Historically, the realization of productivity gains from GPTs has often taken decades. However, this time lag has been diminishing, as evidenced by the consistent decline in adoption lags, representing the duration countries take to implement a new technology after its invention. The increase in annual productivity growth in both the UK and the US, resulting from the adoption of steam and electricity, averaged a modest 0.2% to 0.3%, primarily due to the protracted nature of the gains, especially in the case of steam. However, the impact of the information and communication technology (ICT) revolution was more substantial, partly because shorter impact lags compressed the gains. The United States, experiencing the most significant benefits from ICT developments, is estimated to have achieved an average annual boost to productivity growth between 1995 and 2005 of 1.5 percentage points. The primary impact of AI is anticipated to be the enhancement of multi-factor productivity, achieved through mechanisms such as the improvement of working practices. Historical instances of technology transitions provide parallels to this concept. For instance, when electricity replaced steam in factories, the necessity for workers to be positioned around a centralized power source diminished, allowing for more efficient production lines. The advent of the steam engine and the coordination requirements of railroad schedules prompted the adoption of standardized time, aiding individuals in utilizing their time more efficiently. Similarly, the introduction of email and digital communications facilitated outsourcing and offshoring. An illustration of how AI could elevate working practices is its potential to use predictive demand to optimize how firms assess and adjust their staffing requirements. The potential efficiency gains from AI are substantial, with studies, albeit limited due to the rapidly evolving technology, indicating significant boosts. For instance, an April 2023 study on call centers revealed a 14% increase in agent productivity with AI assistance. While some AI applications, like targeted online advertisements and automated trading, may result in a zero-sum game, AI's impact on sectors like law could significantly improve efficiency. AI's potential role in aiding innovation is also crucial, helping researchers sift through vast amounts of published research, identify research avenues, and predict real-world experiment outcomes. The broader implications span various fields, from drug discovery to material science, potentially leading to permanent productivity growth. However, challenges exist, including the need to intensify research efforts to counter the increasing complexity of scientific advancements. Despite the potential, the realization of gains depends on overcoming barriers, as historical productivity boosts from transformative technologies have often been gradual. The digitalization of the economy over the past decades, including mobile internet and cloud computing, has not translated into significant productivity growth, and early-stage AI has yet to demonstrate a noticeable impact on productivity growth in advanced economies. The impact of new technologies materializes when accompanied by waves of complementary innovations. Additionally, the availability of technology alone does not guarantee substantial productivity gains. Success hinges on effective diffusion by policymakers and firms. Furthermore, for sustained benefits, economies must possess the adaptability to redeploy displaced workers and capital. In response to these considerations, our newly developed proprietary AI Economic Impact Index serves as a tool to assess which economies, encompassing a mix of 33 major developed markets, DMs, and emerging markets, EMS, are well-positioned to harness the potential of AI in the coming decades. The index incorporates 40 sub-indicators, forming 3 pillars that address the crucial factors influencing the impact of AI: innovation, diffusion, and adaptation. These pillars collectively contribute to a composite score, offering a comprehensive evaluation. Clients of Cadvance have access to the underlying data, pillars, and the composite index for a detailed analysis. China excels in AI innovation due to significant investments since it was prioritized in the mid-2010s, yet it lags in diffusion, primarily due to regulatory oversight and leadership influence. While leading in some areas, it ranks 18th overall in our index. Despite this, China's walled-off domestic market and the nurturing of an independent AI ecosystem could impact the global AI landscape. Asian tigers like Hong Kong, Singapore, and South Korea, along with the UK, are well-positioned to benefit, excelling in diffusion, adaptation, and innovation.
The UK government is reportedly considering limiting foreign students and their dependents in a bid to curb rising immigration.
The UK's world-class higher education system and services-oriented economy contribute to its high innovation ranking. Japan and Eurozone economies rank between the US and China, with Japan facing challenges in technology diffusion. The Eurozone's historical constraints, including a less developed venture capital industry and poor cloud infrastructure, may hinder AI innovation potential. Structural issues persist, affecting the diffusion of AI, especially compared to the US. Europe's tendency for regulation may further impede its ability to benefit from AI, with variations in performance among Eurozone countries based on workforce skills and network readiness.
From policymakers to the general public, everyone is hoping for a stable and growing economy this year.
How will all of this impact the global economy in the coming decades? Collectively, productivity growth in the G7 might increase, reminiscent of the rates observed during the ICT revolution of the 1990s, preceding the slowdown in the 2000s and 2010s. Nevertheless, this would still fall short of the robust 3% to 4% productivity growth rates witnessed in most advanced economies during the 1950s and 1960s, driven by factors like industrialization, rapid trade growth, and recovery from the Great Depression and Second World War. Significant variations are anticipated among countries. Our forecast indicates that the U.S. could experience an average productivity growth of 2.3% annually in the 2030s, akin to the rate observed during the 1990s ICT boom. Conversely, we expect lower productivity growth elsewhere, with forecasts indicating approximately 1.5% annually in Canada and the UK. Although this surpasses rates of the last 2 decades, it remains below the levels recorded in the 1990s. Japan, France, and Germany are also projected to see increased productivity growth, but at rates around 1 to 1%, aligning with their lower scores on our AI Economic Impact Index. In Italy, despite the advent of the AI revolution, we anticipate productivity growth remaining below 1%. anticipating that real sovereign bond yields will generally remain above the decade's average, primarily tied to expectations for real short-term interest rates. AI is just one factor influencing equilibrium rates. Other key factors like the impact of the green transition and aging populations are expected to have a similar effect.
The tech space, will we be hearing more stories like this? Big investments in AI, but it doesn't include hiring or even retaining human beings.
AI may exert a short-term disinflationary impact, similar to the increased global labor supply following China's integration into the world trading system, countering potential upward pressure on nominal bond yields. In summary, we project that equilibrium rates and safe bond yields will rise gradually but not dramatically compared to the pre-pandemic decade. What are your thoughts on the transformative influence of artificial intelligence on the global economy? How do you see AI shaping industries and influencing economic landscapes in the future? Share your insights and opinions in the comments below. Don't forget to subscribe to Live Economic News. Thank you for joining us, and until next time, stay informed and stay curious.